All right, so we have two more learning objectives to do in chapter 9. We're not going to do the very last one. Um, so that's the good news. But learning objective 3 is more budgets, and very specifically, we're going to be following the order that you saw in the chart. Learning objective 2. So after the sales budget and the production budget, we actually need to, and the direct materials budget, we have to figure things out for direct labor. We have to figure things out for manufacturing overhead. And then we have selling and administrative expenses. And then once we have all that information, what's probably the most important thing in this part of the chapter is learning what's called the budgeted income statement. So it's actually an income statement based on the budgets. Okay, so you're going to learn how to do that. It's not terrible. It's just time consuming to locate all the information, and I think it'll be fine. Just put in, and that's why I started it today, so you can have the weekend, because it might take you a little bit of time to do some of this stuff. I'm not going to give you a lot, but just enough to annoy the heck out of you. Okay, so direct labor here is the very first one. We need to find out how many hours of labor we need and what the cost of those hours would be. Then, I mean, that's really, really important. And so we find out, first of all, how many units we're going to be producing, and then the amount of labor in time per unit, and then how much per hour for that labor. And that's going to provide us with the total costs of labor. This particular illustration is on page 372 in your book. And so this is, and again, it's not that difficult to figure out, just different and new. So here's an illustration. This is also in your book. We have direct labor hours are determined from the production budget. Remember that production budget from learning objective 2. Matter of fact, we'd have to go back to page 369 in learning objective 2 to look at that illustration, which is illustration 9.5 here, to find all the units that we need to produce. Okay. And at Hayes Company, there are 2 hours of direct labor needed to produce each unit. So for every single unit, which we know from the production budget, it's going to take 2 hours of time to do that. And then the hourly rate will be $10 per hour. And so we get this line of 3,100, 3,600, 4,100, and 4,600. Again, this is each quarter, right, within the year. We get these numbers from the production budget. Okay. Then we multiply that by the number of hours that are needed per unit. And here it tells us it's 2 hours per unit, so times 2. So 6,200 hours are needed to produce those units in the first quarter alone. And again, they're $10 an hour. And so you multiply that by 10. And so just in the first quarter alone, you're going to have $62,000 of labor costs. And then here you've got more units to produce in the second quarter, again at, no problem. Again, 2 hours of labor for each unit, so that's 7,200 hours of labor at $10 an hour. You got $72,000 in the second quarter. in the third quarter, we have 4,100 units, 2 hours each, 8,200 hours, $10 an hour, $82,000 we need. And then in the fourth quarter, we'll be needing to produce 4,600, 2 hours each. That's 9,200 hours, $10 per hour, $92,000. And after the fourth quarter, of course, you got a total, or you can punt. Okay, so that is simply a labor budget. I don't think it's going to be any different. It's not going to be very difficult for you. It should be straightforward. Manufacturing overhead. again, we want to make sure we know what to expect in the cost of manufacturing overhead for that period of time. The one thing that the budget does do that's important is it distinguishes between our fixed overhead costs and our variable overhead costs, which should come no surprise to you at this point in time. Okay. So here what we've got is, and this, if you keep going on, we're still on page 373, by the way. Um, and so that's just a reference point for you in the textbook. So here we have Hayes Company. They have variable costs that will fluctuate with production volume, okay, on the basis of the following rates per labor hour. So everything is going to be based on labor hour, which of course we're going to get from the labor budget that we just did. Okay, the direct labor budget that we just did. Indirect materials are $1 per labor hour. Indirect labor is $1.40 per labor hour. Utilities are 40 cents per labor hour, and maintenance is 20 cents per direct labor hour. Okay, thus, for 6,200 direct labor hours that are needed to produce the 3,100 units that we just did in the other budget, indirect materials are going to be $1 per hour, so another $6,200 are going to be added to that in variable costs, right? And indirect labor is going to be 8,680, which is $1.40, this number here, times the hours. Hayes also recognizes that maintenance is fixed, and so they ask us to prepare the manufacturing overhead budget. And this illustration is on page 373. Again, for your reference, the first thing we do is we understand that our variable costs, the fixed costs are going to be given to us in most cases here, but we will have to calculate our variable costs based on production, okay? Well, it's actually based on labor hour. So if you remember from the previous budget, we had calculated in the first quarter 6,200 labor hours. And so for indirect materials, $1 per hour, 6,200, $1.40 per hour, so that's 6,200 times $1.40 will give us the 8680. 40 cents per hour for utilities times 6,200 gives us the 2480. And the 20 cents per hour for maintenance times the 6,200 gives us 1240. So our variable costs for the first quarter will look like this, 18,600. If you notice, all your fixed costs are going to be the same across the board for every quarter. It's going to be exactly the same. Okay, and these are going to be mostly they're going to be given to you. Sometimes in a lump amount, which is easy. Sometimes it'll be broken out like this. And so you're basically going to be spending your time calculating the variable cost. So again, 7,200 hours times each of these 8,200 hours. Again, we get the hours from the direct labor budget that we just did. Fascinating. So when you have your total variable costs added to your total fixed costs, you have your total manufacturing overhead. Yay. So for the very first quarter, it's $57,100 in total. That's your variable costs plus your fixed costs total together. It's still going to be 6,200 hours, right? So we can actually get a direct an overhead rate per labor hour. If you notice, when you do this across the board for each of the quarters, you'll get a total of $246,400 of manufacturing overhead. If you add up all the hours for all 4 quarters, you'll get 30,800 hours. So that means the overhead per hour of direct labor is $8. So this you're going to need to know, and this will float into another budget eventually. They all float together. Fascinating. Okay, let's keep moving here. The last one, in terms of the budgets that are alone here, the selling and administrative expense budget looks at operating expenses, strictly operating expenses. And so they're not related to the manufacturing of the product that you just saw earlier. So these are selling and administrative. And again, it does distinguish between fixed and variable costs. That should be absolutely no surprise to you in this class. You know, we spent a lot of time understanding the differences between those. So here's an illustration. If you have your book, this is on the top of page 374. Okay, we're doing this in order here. And so you have variable expense rate per unit of sales. Per unit of sales. So this goes way back to the sales budget. If you want to look at the unit per sales that they're budgeting for each quarter, you're going to go back to the sales budget. That tells you, right? So we got commission. Sales commission is $3 per unit. Freight is $1 per unit. Okay. Variable expenses per quarter are based on the unit sales from the sales budget. So this is the previous illustration from Learning Objective 2. Hayes expects sales to be 3,000 units in the first quarter. Fixed expenses are based on the assumed data. So it says here, let's prepare. This particular budget is also on page 374. So the budgeted sales, 30, remember they were going up 500 every quarter. So this came from the actual sales budget back in Learning Objective 2, illustration 9.3 showed the amount of sales in units for each quarter and then the year. Well, your variable expenses are $3 a unit for sales commission. So if you're expecting to sell 3,000 units, your commission is going to be 3,000 times 3 or 9,000. Freight's going to be $1 per unit. Again, if you're expecting to sell 3,000 units at $1 for each freight, 12,000. So your total variable expenses are given at 12,000 for quarter one. You would do the exact same thing, again, based on the sales number of units to calculate your sales commission and freight for each of the quarters to get your total variable expenses for each quarter. And then of course you can just total it up for the year in the last column here. Yes, Ryan.
Would we always have the sales in units like written down somewhere, or would it?
Yeah, it would be in the sales budget. It would be in the
We would
sales
always
budget.
have that like written down somewhere.
It would. They would always refer to a sales budget that you've already done or that's in the book.
Okay.
Yeah.
Thank you.
You're welcome. All the fixed expenses here are given to you. And so that's a wonderful thing. You don't have to worry about it. But if you notice the fixed expenses, the word fixed really means fixed. Okay. So 30,000 for each because it's not changing, right, for every quarter. Total fixed expenses are provided here for all year, all 4 quarters. So that gives you your total selling and administrative expenses for each quarter, which are your fixed and variable expenses added together. So the total variable and the total fixed will give you your total selling and administrative expenses for quarter one. Same here for quarter 2, 3, 4, and then of course the year. Okay. So again, this is, it's really important to sort of reference the fact that, notice how many times we've been referencing a previous budget that we did, right? That's important to know when you're looking at budgets. All these numbers come from the previous budgets, okay, or from another budget that we've already prepared. So you're never going to have to ask yourself, where do I find this information if you simply can just go back into the previous budgets because they're all kind of linked in this way. Drugs are bad, but budgets are good. All right. This is one of the key skills, I would say, in this particular chapter that's important to understand. They basically, it's an income statement. And everyone knows what an income statement is because you've had plenty of them to do in financial accounting. But this is an income statement based on those budgets. So it's called a budgeted income statement. They are pretty good with those labels, aren't they? So it is a very important end product for all of this type of stuff. It does help project the profitability of the operations based on what they have been expecting based on their budgets. Okay, it does help them evaluate how they're doing. La la la. This is important. How do you prepare a budgeted income statement? You need the sales budget, the direct materials budget, the direct labor budget, the manufacturing overhead budget, and the selling and administrative expense budget. All of these budgets are needed because this is where the information is going to come from to do the income statement. Fascinating, fascinating. So one thing to understand is part of an income statement, of course, is your expenses. And probably one of the most important one that we have to calculate first is the cost of goods sold. Cost of goods sold. So what we have to do is find out what's the cost per unit. What's the cost per unit? And so one of the most important things in cost per unit is, of course, the total unit cost is the direct labor costs for one, plus the direct labor hours, plus the manufacturing overhead to produce one product. And our product here is called the right ride. All right, well, whatever. And so if you look at the previous illustrations, okay, the direct materials you would get from the direct materials budget, which is your illustration 9.7. That's what this says. Illustration 9.7 is from page 370. And it tells you right there, you're going to need, first of all, 2 pounds of materials. And each of those is $4 a pound. So to produce one of these products, you need 2 pounds, and those are $4 a pound. So $8 in materials for one product. How much labor? Well, that's illustration 9.9, which we just went over back on page 373. If you look at that budget, you will see that they're expecting that there will be 2 labor hours that are going to be required to produce one of these products, and it's $10 an hour. So it's $20 to produce one unit. And then manufacturing overhead, which is that one of the last budgets we looked at, illustration 9.10, also on page 373, says that we have variable and fixed costs that average $8 per unit. That's the very bottom number on that budget, $8 per unit. It's going to take 2 hours to do it because it's based on labor hours. At $8 per unit, there's your $16 in total. So every single unit of this right ride that we produce is going to cost us $44 in cost of goods sold. So if we sold, again, we can look at what our sales are expected to be, right? If we did end up selling 15,000 units over the course of the year, we multiply it by the cost of goods sold per unit, which is the $44 here, which means our total cost of goods sold would be the 660,000. All right. So we have to understand this is the first necessary step. Understand that cost of goods sold per unit. The budgets we have to go back to are what the illustrations talk about. So you'll have to remember all of that. Again, the number of units that are sold comes from the sales budget. So all the information is part of the other budgets. All right, so if you remember the sales budget, which if you have your book and you turn to page 368, you will see the sales budget at the top of the page, and it says that our expected sales are $900,000 for the year. That's where this $900,000 number comes from. Comes from the sales budget. That's the very first thing that we do in the budgeting process. We subtract out the cost of goods sold. That's what we just calculated on the last page there of 660. So now we have a gross profit of 240. Okay, any questions so far? We're okay? Our selling and administrative expenses, say it's $180,000. This comes from the selling and administrative expense budget, which if you go to illustration 911 on page 374, you'll see the total selling and administrative expenses are given to us as $180,000. So that's why we subtract that out. That gives us our profit or income from operations. And then two pieces of information are given to us. One, interest expense is $100. So we subtract out our interest expense first, give us our income or profit before income taxes. Income taxes are given to us as 12 grand. We subtract out our income tax expense, and bada bing, bada boom, we have a profit or net income of $47,900. So this illustration is very, very important to study to understand where these numbers come from when you are doing a budgeted income statement. Again, it's simply an income statement from the budgets that we've just looked at in this chapter. Fascinating, fascinating. So all of the budgets are used to prepare the budgeted income statement. We do use the sales budget. We do use the selling administrative expense budget. We do use direct labor. What we don't use is capital expenditure budget, which is a financial budget that's coming up in the future real soon. So the do it exercise that's provided for you in the book, it's easier actually just to follow along if you have the book open. This is page 375 in your book. If you just have the Wiley, then it's chapter 9, learning objective 3, 9.3, and scroll to the bottom and you'll see this. So here we have Soriano Company is preparing its budgeted income statement for 2017, right? Relevant data pertaining to sales, production, and direct materials can be found on the following slide. So we don't have to worry about that right now. But we do know that they budget a half an hour for direct labor per unit. Labor costs are $15 an hour. And their overhead is $25 per direct labor hour. So its budgeted selling administrative expenses were 12 million bucks. Okay, so this is information we have to know going into this. So first thing here they want you to do is to calculate the budgeted total unit cost. The second thing is do the income statement. So let's look at the budgeted unit cost first. Okay. When you look at the budgeted unit cost, how much is necessary to produce one unit of whatever they're selling here? Okay. So you need to understand direct materials, direct labor, and manufacturing overhead in order to get that. Okay. So here we have direct materials that tell us each unit requires 3 pounds and it's $5 a pound. We also know from the previous slide that it takes a half an hour of direct labor and at $15 an hour and $25 per hour for labor costs. So that's the information we need to calculate our answer here. Okay, so part A, in this case, we are looking for the budgeted total unit cost. We're looking at how much does it cost to produce one unit of this product. It's direct materials, direct labor, manufacturing overhead. 3 pounds, $5 a pound. That was given to us in the information there. The first slide told us it took a half an hour to put this together in direct labor, $15 an hour, so half of that per unit, $750. Late overhead follows labor. Half an hour at $25, so it's $12.50. So this $35 is literally the cost. We're going to be using that times the number of units they sold to figure out our cost of goods sold. So the next thing is our actual budget. So the first thing we have to do is we have to look at our sales, and this goes back to do it exercise number 2. So if you look at do it exercise number 2, which is found on page 371 in the book, it tells us that Soriano is going to sell 1.2 million units at a, what was the price? I don't remember off the top of my head. Actually, let me just go back a few pages.
$50 per unit.
50, thank you very much. Yes, exactly. $50 per unit, except the last quarter was 55. Okay, that's right. So except the last quarter, the fourth quarter was 55. So that totaled $61,500,000. That's on page 371 in the do it exercise that's done for you. So we've already calculated, we already know how many units they're going to sell. The cost of goods sold is the amount of units times part A, $35 per unit. And so we multiply that out, and it's going to cost us $42 million to produce all of this stuff. That's our cost of goods sold. The difference of those is the gross profit, $19,500,000. The selling and administrative expenses were given to us as a flat amount in the problem. It just tells us it's 12, I think it's 12 million. So we simply subtract that out. And that gives us, there's nothing to calculate here. And that gives us our profit net income for the year of $7.5 million. And that is a budgeted income statement. Ryan, do you have your hand back up? No. Okay, I thought I saw a hand up again, but I guess it's seeing things here. All right, any questions on this whatsoever? You're doing okay? All right, we got one more big push. So I just want to, does anyone need like a little 2-minute break just to walk around? No? I got a thumbs down. I don't think I've ever gotten a thumbs down. Particularly from Hector. I always get thumbs up. All right. Okay, so are you ready for the last part, as they say? Okay, I'm getting some thumbs. I'm hoping they're thumbs. We've got lots of fingers to choose from. Amen, hallelujah. All right, so let's go to that last part and see if we can wrap it up. So again, this is the budgeted income statement. The next one and the next part is going to be something called the budgeted balance sheet. It's a little bit more to it. You're going to have a little bit of work to do this weekend on figuring out where to find the information from all these different budgets. That's going to be the trick. But once you know where to pull the information from, you already know how to do an income statement. You already know how to do a balance sheet. It's not going to be a lot of extra work. Okay, so just keep that in mind. That once you learn where to find the info, putting it together is not bad. Okay. So here we go. Pardon me. Learning objective 4. Now, this is a very important learning objective because there's actually 2 things you're going to be learning that's important. One of the more important budgets that a business is going to have is something called a cash budget. And a cash budget basically follows cash coming in, cash going out. And if they need any money, that's going to be necessary to put in the cash budget. They are going to anticipate needing to borrow money to meet cash needs and to pay loans when they need to. So a cash budget is a very critical budget. It's one of the more important budgets that you'll ever know about in an organization because it tells you everything you need to know. Okay, what does it really contain? Cash receipts, how much cash is coming in? Cash disbursements, yes, I'm having too much water today. Cash disbursements, which is basically cash being paid out, right? And then if the difference between these in any quarter is too great, they might need to borrow money to make sure they can pay their bills. And so that's the financing part. And of course, the cash balance starts with the beginning amount of cash. And after we look at all of this information, we'll have an ending cash balance as well. So you'll see how this looks, and it's actually quite easy. So here we're looking at any company. Their cash budget. Again, it starts with the beginning amount of cash, so what they start with the period. They're going to add what they think they're going to be collecting in receipts, and I think we're going to be looking at that in more detail. That gives them the total cash that they have available. They're going to take away the amount of disbursements, which is the payments. There may be some left over, so there might be excess. If they need more money to more cash in to meet those, there'll be a deficiency. If there's a deficiency, there needs to be some borrowing going on, some financing going on to meet the need there. And then there's going to be an ending cash balance. So you're going to see this play out in your book. It's on page 376 to start. So again, receipts, anything in which cash is coming in. Most cash comes in because you sold goods and services and you're collecting cash from customers. But cash can come in other ways. You can get interest on your deposits. You can get dividends. You can sell some of your assets or investments and get cash that way. You can also sell more stock and get cash coming in that way. So cash comes in a number of different ways, as you see here. Cash only goes out because you got bills to pay. Most of the time, although you can plan to purchase assets as well and other things. But in this case, thankfully it's simplified. You need cash to pay for materials. You need cash to pay for labor. You need cash to pay for all that overhead. And you need cash to pay all those selling and administrative expenses. So this is the immediate cash payments or cash going out of the company. If there's any difference between the receipts, particularly in a quarter, and the amount of disbursements in a quarter, it might be time to borrow. And so if it's time to borrow, it's because you have too many disbursements and not enough cash coming in to meet that. It's a common thing. It's nothing to really freak out over in business. Businesses always manage this pretty well. It's like, oh, I don't have any money to meet this. That's why you always need lines of credit, because you're going to always need to have some way on occasion to borrow when there's less cash. Sometimes you'll have a lot of cash coming in and you won't need to borrow. Sometimes you'll need more cash than you have, and so you have to borrow. So the financing section shows when you expect to actually borrow money. And then, of course, you need to repay those. Usually it's right in the next quarter. These are usually very short-term loans that are happening in this line of credit. Again, plus interest. Okay, so again, you start with just some interesting things here. You must prepare the cash budget in sequence. There's the ending cash balance of the first quarter, for example, is the beginning cash balance of the second quarter. The ending cash balance of the second quarter is the beginning cash balance of the third quarter, things like that. You'll see it's relatively straightforward. It's often prepared for a year, but they do it on a monthly basis because your expenses are usually budgeted on a monthly basis. And so, you got rent and other things that you would normally pay on a monthly basis. So it's easier to do a cash budget month to month, but you're going to do 12 of them for the whole year, in essence. It does help you effectively manage cash and understanding where your needs are, and you can plan for that ahead of time. And there might also be times when there's a lot of cash on the sheets, and you're going to need to decide, do we do something else with that particular cash? So here's your illustration. This is in the book. It's much easier to follow in the book than it is on all these slides, to be honest with you here. Of course, I'm always honest with you, but this is even more direct. This is on page 377. So if you have your book and on page 377, or if you're in the Wiley and you see learning objective 4, so 9.4 in Wiley, you'll see this illustration. Again, they start on January the 1st. There's a cash balance that's $38,000 to begin the year. Now, this is important to understand. Sometimes, it's not a good idea for businesses to have a very low balance in their cash account. So oftentimes they want to maintain a certain balance. This is part of policy at a lot of companies. And so they'll, in this case, Hayes Company says, look, we want to make sure at the end of every quarter, there's at least $15,000 in the account. If there's anything less than 15,000, we got to go borrow. So that's important to know. Their sales, now most of their sales are interesting because they collect 60% of the money in the quarter that they make the sale, but they collect the other 40% of that cash, and these are cash collections. They collect the other 40% of that cash in the following quarter. So for every $100 you sell right now, say it's the first quarter, you're collecting $60 in cash this quarter. You'll get the other $40 next quarter. So that's part of the cash flow that they're looking at. Accounts receivable at the end of last year was 60,000, okay? And they're expected to be collected in full for 2017 first quarter. So we're going to be doing a cash budget for 2017. Short-term investments, they're going to be selling $2,000 worth of investments in the first quarter. So that's more cash coming in. And then here we're looking at our budgets now, our direct materials budgets, whatever we decided we needed to buy for direct materials. We know that 50% of the money is paid in that quarter. The other 50% is paid in the following quarter. So again, this is a cash disbursement. They're going to pay half of it up front. They'll pay the other half next quarter, but they do that every quarter. So, and again, they're going to need materials every single quarter. So they're doing this every single quarter. The previous balance before this budget took place was $10,600 at the end of December. Of course, they're going to pay all of that in the first quarter of 2017. Direct labor is paid when it happens, okay? Because I doubt you would want to work for a company that says, hey, work for me this month. I'll give you half this month and half next month. I don't think anyone would want to work for a company like that, okay? So they're paying everything in full. Manufacturing overhead, again, which is the budget on that illustration here. Selling and administrative expenses, which the budget is shown here. All of these items are paid in the quarter they happen. Okay. So again, we have to find out what our overhead is and our selling and administrative expenses are, because that amount of money, along with direct labor, is happening in the quarter it happened. It's getting paid. They're planning to buy a truck in the second quarter, okay, for $10,000 cash. I don't know, it's a relatively small truck apparently, or it's quite used. Not a lot of trucks for 10 grand going out there, but anyway, that's their purchase, and it's going to happen in the second quarter. So they're going to need cash for this purchase. That's why they told you this. They make equal tax payments for income taxes. So whatever they owe in income taxes, they pay equally every quarter. Okay. And then here they're going to repay their loans in the earliest quarter there's sufficient cash. So in case they have to borrow money, they're going to pay it the very next quarter. If there's enough cash, they'll pay it in full. Okay. So now it's asking us to, with all that information, prepare the schedule, release the Kraken here. Okay, so what we got here is a lot of little bits of information here. The first schedule that's looked at is, when are we going to collect our money from customers here, right? And again, if you remember a little bit, we collect 60% up front and the other 40% next quarter. Okay, so the ending receivable from 16 is going to be collected right up front in the first quarter of 17. First quarter of 17. And then of the sales, right, 60% of those sales are going to be collected in cash in the first quarter, the other 40% in the next. So this number, the numbers you see here for sales are simply going to be broken into what you're collecting now, what you're collecting later, which is a 60-40 split. Okay. So $108,000 is 60% of your first quarter sales. So look how much cash you're going to be collecting from customers in the first quarter, 168 grand in cash. Okay. For the second quarter, you're going to collect the other part of those first quarter sales and 60% of the second quarter sales. And this is how you do it, quarter to quarter to quarter. Okay. Oh, I need to one more time. So this is the amount of cash that's coming in from customers. That's what you expect anyway, expected collections. This is what you're budgeted for in terms of the amount of cash you're collecting. So are you okay reading this? Okay, that's important. So that's the beginning. That's illustration 9-15. Now we need to figure out when we're going to be paying for our direct materials. And as you remember, for direct materials, we pay half in the quarter we buy it. We pay the other half the next quarter. So these are actual. So the first budget is how much money is coming in. That's cash receipt. This is actually disbursements, cash payments, money going out, cash going out. So again, they've given us a little bit of information from the previous quarter in terms of accounts payable, and they told us that 10,600 of that was going to be paid in the first quarter of 2017. So that's where that number came from. And then half of that number is going to be also paid up front. So for direct materials, we need to cough up 23,200 in the first quarter. So again, half of the materials that you need in the first quarter are paid in the first quarter, the other half in the second quarter. Okay. And so that other 12,600 will be paid in the second quarter. You need 29,200 in the second quarter. You're paying half now and half in the next quarter. So you're splitting that number, in this case, in two. But as you see, you get a total. You need $27,200 of cash to pay for those materials in the second quarter. Half of that number, right, means you need $31,200 in the third quarter to pay for all the materials you need to produce what you're producing. And in the last quarter, you need $35,200. So this is cash going out because you're paying for material. Lots of stuff here, okay? And it just went over the materials budget with you, but all of these budgets, direct labor, manufacturing overhead, selling and administrative expenses, this is information you would get from the previous budgets. So first of all, the assumptions are provided in what that big list of things that we went through earlier. This is the very first quarter for 2017. They have $38,000 of cash on hand. They're expecting $170,000 of cash to come in, $168,000 from customers, $2,000 from selling those securities. That's the $170,000. The $208,000 are those two numbers added together. So that's the total cash they're going to have in the first quarter. We already saw how they needed $23,300 for materials. They need $62,000 for labor in the first quarter, $53,300 for overhead, $41,000 for selling and administrative, nothing for the truck, but they have income tax, $12,000. They pay it equally, $3,333, right? So they need to pay out $182,500 of cash. Well, they have $208,000 of cash expected in that quarter. That's what they need to pay out. They have $25,500 more than they need. And that becomes the balance at the end of that quarter, because there's no need to borrow because they're over 15,000. The ending balance of the first quarter is the beginning balance of the second quarter. Okay, we follow that? They are expecting to collect $198,000 from customers. You saw how that was done. No other receipts. So they're expecting $198,000 to the $25,000 they already have. So they're going to have $223,500 of cash available in the second quarter. But as you see, their expenses have gone up. The amount of cash they need is going up, particularly that extra $10,000 here for the truck. They want to purchase that truck. So they actually need $211,500. They can cover all of that, but their balance would be $12,000. They don't want to have a balance below $15,000. So in this case, they're going to need to borrow $3,000. So the borrowings here is simply to keep the minimum balance in their cash account at $15,000. Okay. The $15,000 for the end of quarter 2 is the beginning of quarter 3. The amount they're collecting from customers, the total amount of cash they have, all the expenses, that's the amount of cash they need to disperse. They have plenty more, $22,500. Now this is this is much higher than the $15,000 that they need. So they'll pay the loan back and they'll have $19,400, which is much higher than the $15,000. So again, once they have a balance that's much higher than what they need, they'll pay off the loan from the previous quarter. This ending balance is your beginning balance in the fourth quarter here. You're adding your cash from customers, total cash coming in, total cash you need to go out. There's your difference. That's your ending cash. Your cash budget is done. Can everybody read this okay? Any questions while I'm on the slide?
Looks good.
Okay. Yeah, it looks wonderful. So now we're at the budgeted balance sheet. So again, it's a balance sheet that's based on all the budgets plus some additional information. Okay, there's always going to be like a little bit of additional information that's going to be given to you regarding that. And so the additional information here includes your building and equipment, common stock, cumulative depreciation, and retained earnings. Okay. Now the retained earnings balance is going to be different for sure, because this is the end of 2016 and you're doing it 2017. So you're going to have to add any net income that you projected on the budgeted income statement to that. Okay, just to know. All right. And remember too, you bought a truck. Second quarter, you bought that truck. That's not here. You have to add it in. Okay, so here's your budgeted balance sheet. Again, your assets are given to you for the most part. Again, one of the differences is your buildings and equipment will increase because you bought that truck. Just to check one other quick thing here. Okay. Then in terms of your retained earnings, you're going to see that change because this, so this is definitely going to change with the truck. This is also going to change because you have projected in your budgeted income statement a profit for 2017. So you have to add that profit into the retained earnings previously. It doesn't say that that you paid any dividends. And so in that sense, you should be all set. There. Okay. Oh, and by the way, the cash balance here, you'll get the cash balance from the cash budget that you just did. at the end of the year. You'll get your cash balance right there. Okay, so again, as long as most of this is okay, that's good. So again, pertinent information. You had cash at the end of the year of $37,900. You actually had from illustration 915, which is on page 377, showing that you had $270,000 of sales, and you're going to be collecting, you have receivables of 40% of that. So that's where the 108,000 comes from. It's 40% of your receivables from that quarter. The third thing is finished goods inventory. So in the production budget, which is way back on illustration 9.5, so we're scrolling back to page 369. 369. Yes, 369. You're going to see that the day one ending inventory at the end of that period of time would be 1,000. Okay, desired ending inventory is line 7 of that production budget. So if you have 1,000 desired ending inventory and they are going to cost you $44, remember your inventory is valued at the cost. So 44,000 times 1,000 units is where the $44,000 for finished goods comes from. So this comes from that budget. Okay. Raw materials, you have ending inventory from your illustration, from your budget, that's part of illustration 9.7, of 1,020 pounds, and it's $4 a pound. So this is a raw material inventory. You multiply that out and you're going to get the $4,080 that's shown here. Okay, so your total current assets were 193. You had that, you had the equipment, you had the truck that you had to add. And so you have $337,980 of assets. Let's take a look at how these liabilities came into play. Oh, first of all, I'm sorry. The cumulative depreciation account changed because we had to. All right. So let's go to the overhead budget to see where that number came from. Again, it's a matter of going back and forth to these budgets. And once you figure it out, it's not as bad. Overhead budget here shows depreciation as one of the fixed costs in your manufacturing overhead budget. And their depreciation is a total of $15,200. So that's where this number came from. And this $4,000 of additional depreciation came from your selling and administration budget, which is on page 374 under the fixed expenses here as well. And that's the other 4,000. So you're going to add to your depreciation that's already there, 15,200 from that budget plus another 4,000 from that from the other budget, and that's where the $48,000 comes from for cumulative depreciation. I forgot something there. Okay, so accounts payable here. Basically, we know from illustration 916, which is on page 378, that shows our expected payments for materials. At the very end of the fourth quarter, you'll see that we paid half of the purchases and we need to pay the other half. And the other half happens to be, if I'm reading this right, $18,600. So when you look back at that budget, 18,600 is that other half from the fourth quarter of the schedule of expected payments for direct material. Common stock, I don't think changes. I don't think they actually sold, right, they didn't sell anything. Okay, so there's no change there. But retained earnings changes because you had a beginning balance and you had net income that you calculated from the budgeted income statement. So those two together would give you your new retained earnings. Okay. This particular question here, they have direct materials purchases are $70,000 in the first quarter, $90,000 in the second quarter. 40% are paid in cash as incurred. The balance is paid in the following quarter. So what's the budgeted cash payments for purchase in the second quarter? Right. Well, in the second quarter, they had $90,000, right, of purchases. 40% of that is paid in cash. So you take 40% of that, and that's the beginning. And then the other 60% of this is also going to be paid. And that's where you get the $78,000. 40% of 90 plus 60% of 70 is your 78,000. Okay, well, I don't know if I need to actually go through a lot here, other than the fact that the do it exercise, thankfully, just shows you about the cash budget. And actually, this is actually quite straightforward. It's very, very straightforward. Cash budgets usually are. Remember, you start with an amount of cash, you're adding in your receipts, subtracting out your disbursements, and if you need financing, you would put that in too. So here we have Marsh & Company. They have a monthly cash balance minimum. They want to keep at least $15,000 in the account at all times. So at the beginning of March, their balance is $16,500, which you see right here. Okay. Cash receipts are expected to be $210. Cash disbursements are expected to be $220. How much cash, if any, should they borrow? So again, they have $210 coming in. So they have a total of $226,500 in cash available. They have $220 going out, which means they'll have a balance of $6,500. That's well below the $15,000 minimum they want. So they're going to have to borrow the rest, $8,500. Okay, and I've just gone back to the main screen and you're all blanked out, which, that's how budget meetings go sometimes. Just a lot of folks just like, if I could turn my video off, I would. I've been in those meetings. But there's a lot of layers to this, but all those layers have the information you need to put together at least the budgeted income statement, which is very important, and the budgeted balance sheet, which I'm not sure I'm going to actually have you do much of, but just maybe this much. But the budgeted income statement is very important. Cash budget is important. Budgeted income, budgeted balance sheet is also important, but I'm not sure I'm going to have you prepare very much of that. Mm-hmm. So you certainly have your work cut out for you. Are there any questions?